This trading concept I'm about to show you will change the way you view and perceive the markets. And if you keep watching until the end, I'm going to show you exactly how to apply it in the trading world. Hi there and welcome back to the How to Trade YouTube channel. My name is Connor Woods, one of the trading coaches here. And in today's video, we're going to dive into the world of liquidity. This is going to open your eye to how the markets really work, especially when it comes to stop loss hunting. Learning this market trickery will leave you in an excellent place to avoid your orders following the pattern of a typical retail trader. So I want you to ask yourself this question. I'm drawing out a trade in front of you now. How many times has your trade hit your stop loss before swiftly moving in the direction that you initially predicted? A lot, right? And it can be quite frustrating. Well, that is called a stop loss hunt, when the price moves to an area just above or below typical retail traders' stop losses before reversing and moving in the other direction. Now, it's really important. I wouldn't recommend developing a victim mentality where you believe market makers are out to get your stop losses as they don't want you in the market. This may or may not be true, but it's an unhealthy attitude. Instead, we can be a step ahead and mark these levels prior to it happening, and we call those areas liquidity. Okay, so let's take a look at the hierarchy of market participants. Really important. We need to understand that trading is a zero-sum game. That means in order for you to be buying the market, someone needs to be on the other side selling and vice versa. Now, this is the same for anyone in the markets. However, when you look at the hierarchy of market participants, this diagram we've got here, as you move up the list, so as you move from individual retail traders up to hedge funds, up to investment banks, up to major banks, up to liquidity providers, the actual average order volume increases as well. Now, this is apparently a problem for the big players at the top, because there may not be enough liquidity, there may not be enough large orders large enough to take the other side of the trades. Typically, all large institutions will have some sort of order flow book which shows orders placed at different levels. So what actually is the theory behind it? Because obviously this is just a theory, it's not necessarily gospel. No one knows if this is true or not, but the theory is that they can use a small amount of money to manipulate the price to this pool of stop losses that a typical retail trader would have, or buy stop orders, for example, or sell stop orders at lows. This is basically liquidity pools. When you're stopped out, therefore, this triggers buy orders as well as takes you out of the market. That's what you got to remember. Now, this gives the big players, apparently, the money they need initially on the other side of their trades to really move the market in the direction that it was originally intended for. And this is why you'll rarely see the market move meaningfully without grabbing liquidity somewhere first. So you can see the example here. The market's moved lower initially, but then apparently, according to the theory of liquidity, you've got big players placing a small buy order to grab enough liquidity, because you think if you were selling the market here, you'd have a lot of stop losses up here. It wicks into that liquidity area and then we get that move lower. So how that looks from a bullish and a bearish example is basically like a false breakout. So the body of the candle will close back inside the range, leaving a wick above or below the high or low. And once liquidity's been grabbed, we can then use our other concepts to enter the market, whether that be supply and demand, imbalance, FVG, indicators, however you actually use your entry criteria. We can basically wait for the liquidity grab, then get involved. So in this example here, the buy side liquidity at the top was taken before the move lower. And down here on the sell side liquidity, you can see that wick to the bottom, all the selling stop losses taken out there, and all the sell stop orders tagged in as well. Then the market moves higher. Let's take a look at examples on the chart. Okay, so here we're faced with AUD USD. It doesn't really matter. It works on any chart. So what we're looking for is we're looking for sort of key highs, key lows, where, you know, the market failed to close above and we actually sort of wicked back inside, and we can see exactly what happens on pretty much every single occasion. Let's look at the very top of this market here. Okay. So you can see the market was running high, We had a little bit of a sell-off here, probably a sign, you know, when we marry it up with fundamentals and with the dollar strength coming through at this time, that this market wants to go lower, okay? We've broken some structural lows here along the way. So everyone's piling in sells here. The problem is, you know, the big players may want to sell this market, but there's not enough of the other side of the order for it to generate enough liquidity to go lower. So what happens here? This is our buy side liquidity. You can see market runs down, the big players, you know, theoretically, a small buy order to take the market up towards where this liquidity is, fail to have any real, you know, proper candle closure above. That's liquidity taken. Look what happens straight away. Boom. You know, huge move to the downside. So that buy side liquidity has now been taken. And that's how we can successfully market. If we're going to trade it, you know, sometimes I'd say the more riskier way to trade false breakouts would literally be as soon as we get a closure back inside. If you see something like this, you see there's a small candle closure above, you know, it's nothing convincing. It still can be classed as a liquidity grab. As soon as we get that close below, what some traders can do is they can literally go short at the close of the candle, which closes inside the range, stop loss above the liquidity grab, the stop loss hunt, and then wherever your take profit is, whether you're targeting lows, etc. You know, and this carried on to, you know, yield 12 to 1 and more. The issue is, of course, you know, that is a riskier way of trading it. We can follow the price action all the way, and it happens. You know, internally as well within the market structure. It doesn't have to be at key highs or lows. When we get that move down, we can see the market starts to correct a little bit, and we get exactly the same thing. Buy side liquidity internally inside the structure, you know, wicked into this level, and then again traded lower, and that's where we are now. That's okay as a standalone. It's a standalone method or strategy. That's fine, but we want to use it with other concepts as well to really, you know, solidify our view of liquidity. So what I'd suggest is just going through and just trying to find where we've had that previously in the past, and you can scroll through and you'll probably find it, you know, here as well. You can see it, and then we snapped higher. You can see it everywhere, okay? But we want to be able to spot it before it sort of happens. So we want to use it in conjunction with supply and demand zones. So I'm on the DAX chart, which is the German indices. Again, this works with anything. So what we want to do is we want to try and see if there's any sort of, you know, if you look at the market structure, you know, we're looking for buys, okay? The market's clearly looking for buys. Probably the big players want buys, institutions want buys, retail traders want to buy. Everyone wants to buy this market because look at the run up we've had. Everyone wants to get in, but the problem is that the big players need the liquidity to generate this move higher, and that's what we've got to think like. And it's a mentality change more than anything. So what you can see is if we can mark quite a nice demand zone here. The reason that's a demand zone is because that's the previous sell to buy a candle, which really broke, you know, the all-time highs in this stock. So clearly some big buying power. Clear consolidation in this range. Ask yourself, where's the liquidity? If people were going to be buying this market from here, which a lot of people are, you know, where would their stop losses be? Probably below this low. Makes sense, right? It's below the most recent low. That's probably where people would have their stop losses. Sell side liquidity here. Now we know that what we need to see is, you know, we need to see a target of this liquidity and then into our demand zone. So that's extra confluence, really, really nice, and then a move higher. So potentially what you could do is if you were to get a play like this, is you could set up that something looks a little bit like this. Maybe we want to cover that low there for our stop loss, and then we're really sort of targeting, you know, highs along the way, for example 4 to 1, or if you just want to target 3 to 1, that depends on your sort of risk management. And then we just play it through and just see exactly what happens here. So we start to trade lower. Oh, look, there we go. Wicked into that level. We started to trade below. It can be a little bit scary because at the time that's a full body, you know, candle on a 4-hour chart, which is looking okay. But look, we know the story here. Sell side liquidity, demand zone. What happens? Close back inside, and then look, snapping higher as we speak. We can see the same for a sell example here. We've got Euro Yen. Okay. Supply zone, broken structure to the downside. We broke this low. All come from that move. Look at that huge move. This is a key supply zone we've got here. Okay, what do we notice?
Yes, okay, so people may have sold from this supply zone. That's fine. People may have sold, you know, straight from the retest of this supply zone because it broke structure to the downside and may have targeted these lows down here. But you can see exactly what happened is we traded, you know, 3 to 1. So it would have been a successful trade, or sorry, 3 to 1. It would have been a successful trade, but then stopped out at entry, not hitting our full target. But why is this? Because even though the market looks like it wants to go down from this level, we haven't generated enough liquidity to really move the market down. So when we ask ourselves where the liquidity is, anyone who sold from here or from down here, for example, where would they have their stop loss? Well, ignore where this supply zone is, probably above this high. Okay? Sell side liquidity. What happens here? The market trades a little bit lower, but then comes that's that small buy order from large institutions to generate enough liquidity to now go lower. Look what happens. We're still in this supply zone, so the trade's still valid. We're still in a good area of business. We wick into that level, you know, close back inside, and then already starting to trade to the downside. And that is the power of liquidity. Practice yourself, go through, have a look through the charts, look for key lows, key highs, and try and mark liquidity first of all. Then we want to look for sort of internal liquidity we see sort of inside a structure. I can show you just quickly another example, which is a trade I had on in the trading room. On the 1 hour chart. You can see here, internal liquidity. This was a trade I had. Okay, so within this structure, we've got some liquidity here. Okay, and then when we come and spike and create that liquidity, we also create a supply zone. Why? Because that broke this structure low. And we know we're sort of fundamentally bearish, or the general direction and market structure at the moment in stocks is bearish. So we know we've got a break of that low. So therefore, therefore we know that anywhere around here, we've had the liquidity sweep already. Any sort of retest that we can get, we can look to go short, you know. Stop loss just above, play it through, wicked in, and then traded lower, a lot lower, 6 to 7 to 1 trade, and that's just using that internal buy side liquidity we have there inside the range. So practice looking at the key highs and key lows first. Always liquidity there. Always think to yourself, where would people's either buy or sell stop orders be, which is like a continuation trade, or where would their stop losses be? These are areas that are targeted. Again, it's not personal. It's just the area where there's the most liquidity to really drive the move in the other direction. That changes the way that you view sort of market structure highs and market structure lows. A lot of people say, "Oh, as soon as we get to trade at this high, you know, we're gonna buy," and so many buy orders come flying in there. But those buy orders just give the liquidity to the big players that can move the market in the other direction. So that, my friends, is the power of liquidity.
Now remember to always ask yourself, where is the liquidity? If you can remember to do that, along with correctly marking it on your chart, you're in the best shape to avoid retail traps. Liquidity is needed to generate large moves, and often it's taken from the places everyone has their orders. This is an important confluence in the smart money method. But remember, this is all theoretical, and to never take anything personal in trading. Thank you for watching, and if you like, feel free to subscribe to our YouTube channel, turn those notifications on so you never miss out on the content we're releasing on the channel. Until next time, trade well, and we'll see you soon.